potentially starting with you, Adrien. It'd be good to hear how CIS is sort of looking at the current environment and also how your positioning has evolved in light of what's happened in the last few days and sort of how you're preparing for the coming months.
Well, yeah, we see last week's announcement as an external shock to a global economy and the global markets that were in decent shape, let's say. So that's important for us, the starting point, that the situation before this announcement was okay at the global level. The US growth was slowing down a bit, but there was no specific significant issue before that. Clearly, this is a very large external shock with impacts, firstly on, of course, US inflation and therefore potential consumption and growth ahead in the US. Implication also for growth in other countries that are exporting to the US, because it might affect the exporting sectors. That's the first dimension, a potential slowdown in global growth, let's say, in the coming months, and the risk of a recession that was low in our view before that, this risk that has significantly increased. There is another dimension which is maybe less tangible or more difficult to assess, but which is one of very high or increased uncertainty and potential loss of confidence or diminution in the confidence with respect to the US, this notion of US exceptionalism that made most of last year, that is being eroded. And in our views, this is the reason for the underperformance of dollar assets in general and the US dollar in particular. And there is lastly another even more difficult dimension to assess, which is the potential impact that it would have on the global economy in terms of reorganization of supply chains. And this is something that cannot be addressed very rapidly, but that leads us to reassess the positioning. So let's say those three dimensions with different time horizon and different implications that we are trying to incorporate into our views. In terms of positioning, we had reduced the risk in our portfolios already at the end of February because of the uncertainty around this potential announcement. We clearly didn't expect something as brutal as last Wednesday's announcement, but we were conscious that it could be maybe disruptive, and on top of that, we were seeing some slowdown in growth dynamics in the US. So we entered last week with, let's say, not strong overweight, to be frank, but a cautious positioning overall in portfolios. And so far, we haven't made specific or significant adjustment in our positioning. We are looking at some some protection for potential further downward on the equity side, because clearly one important dimension is potential escalation and retaliation and proper trade wars that will push the global economy clearly into a recession. In that case, we think equity markets have further downside, but for the moment we are willing rather to add some downside protection rather than reduce outright exposure in the portfolios. But what is clear for us at this stage is that we are not yet willing to buy the dips neither, and we are not we see the risk and uncertainties for the time being too high to consider reinvesting in some areas of the market, even if it's something we always have in mind, because at some point there will be some opportunities.
Christoph, Adrien, it'd be good to hear a little bit more just about those downside protections you're going into at the moment. Could you tell us a bit more?
So for the structure we are currently looking at are some combination of some structured product with some building some with put options, basically selling and just trying to incorporate or help the portfolios to eventually to benefit from one positive contribution in case the downside continues. So it's a basically structured product based on options.
You're interesting. Mikhail, coming to you, it'd be good to hear a little bit about how your team's viewing the last few days. I can understand it probably stirs some nervous laughter to talk about what's happened over the last few sessions, but also Good to hear a little bit about how you're viewing the kind of asset allocator playbook at the moment, how things changed, and yeah, how you're expecting to position over the sort of coming months.
Yes, sure. So, I mean, I can only agree with Adrien. I mean, it's a shock to an environment which was relatively benign to start with and relatively supportive. It's not the first shock that we go through, and I think that especially our investors and our clients, that's the message we try to convey. Try to put yourself back in your shoes, in 2020 when, on March 16th, you were asked to go back home and all the implications for what it meant for the world economy. I think we can very easily do that. And even the shock of rate increases in 2022, which is even fresher in everyone's minds. So what I'm trying to say with this is that we're really in the eye of the cyclone, the tornado, and the worst thing to do when that happens is to start running around like crazy chickens. And that what that means is we're not overreacting. We're trying to stay away from being too affected by the headlines because they have a tendency to move very quickly. We try to focus on the fundamentals, trying to see how the 10-year is moving and what the market is telling us, trying to see obviously which of the announcements are really going to have weight, what China, for instance, announced and started doing with the support of certain asset classes and the pledges for loans, etc. That's structural and providing some kind of a floor to what is happening. And these are the things that matter. We were lucky in a sense, hopefully we do our job well, but we were lucky in a sense in reducing exposures as early as the end of last year in November. If you look at a balanced portfolio today, it's roughly exposed 42% to equities, and we had done so mostly through the reduction of the US. So that's been very helpful. Getting into this year, we were expecting more volatility. Definitely not the level of volatility that we're seeing now. So hence the cringy kind of smile and laugh at the beginning of our discussion. But going forward, I think you need to stick to quality. I think there are things to be done in long-term rates, but they tend to move really fast. And that's also dangerous depending on your ability to implement those changes in your portfolio swiftly. We have been holders of gold for quite some time now. It's about 7% in our portfolios. Look at the gold's move, for instance, recently. It moved all the way up to 3,130, I think, and then down to below 3,000, 2,900, 800. If you were starting to act on those moves out of fear for an asset class which has had a tremendous run, an even better run than U.S. equities, you were doing the wrong thing. Sorry, and us holding to our positions, and now gold is back up to about 3,000. I think speaks to the structural and fundamental attributes of certain asset classes. But going forward, to answer your question more specifically, I think this is a time for diversification regionally. In terms of styles, I think you need to be a lot more discerning when it comes to what you invest into. I also agree with Adrien. I don't think it's time to buy the dip yet. Look at US equities. Maybe you'd wait until they start hitting their long-term valuations averages before looking at it again. And definitely, we believe in the base scenario. We believe in some forms of resolutions, some negotiations, a lot of hard talk, a lot of fighting, but down the road, and we've seen it. Look at what Switzerland did. No retaliation, the will to talk. Look at what the UK did. So far, no retaliation, the will to talk. Even if Europe will retaliate somewhat, there is that will to talk. And frankly, the proposal to have 0% tariff barriers for industrial goods was a sign of good faith. It was not accepted by the Trump administration, but I think it goes in the right direction. So expect volatility going forward, but down the road, I think the scenario of a slowdown, but not a massive meltdown of the global economy, is still our favored perspective.
Very interesting. And if we look at this sort of slowdown scenario here, we're seeing a bit of a pincer movement in tariffs, both on input costs for manufacturers, but also then potentially lower demand as consumers face those higher prices as they sort of feed through. It'd be good to hear just a little bit more from you about sort of corporate earnings this year. What are you sort of expecting? What sectors are you favoring? And obviously, as well, you mentioned diversifying regionally. We could hear a little bit about into what regions you're going outside of the US.
Yes, definitely. So let's start from the easier part of the question. I'd say regionally, we've been, as I said earlier, kind of mechanically over exposed to Europe and Switzerland. This is something we will continue doing. There is such an imbalance within Europe in terms of, equity market sizes between different countries, etc., that we try to avoid being too dogmatic on where we want to invest. And we've seen the great performance of Germany over the past several months, but you can also see how quickly it reverses, and you can see how some themes, which seem like structurally good plays, can really start playing against you because of how far they've gone. Think about Rheinmetall going down 30%, etc. So regionally, I think this is where we're going to stick. We don't have a huge allocation to emerging markets for the time being because we're very wary of what's happening with China still. Yes, they are the one place in the world that has the means to respond, both in terms of tariffs, but also in terms of policy. But if you look at it, China has always been a difficult play. If you had invested $100 when they entered the WTO, you would have lost money today. And that's because the equity market in China doesn't work exactly the same way as in other truly capitalist areas. Looking at sectors, obviously we're remaining defensive. We are a little bit wary still about the AI theme. We believe it's, as I said earlier, too early to jump back into this, but I believe that some areas, healthcare that was spared to the greatest part by the tariffs, staples, especially if you believe there's going to be a slowdown and you think about the polarization of consumers, you want to be exposed to those names that offer the cheaper retail experience because that's where people are going to flock to. These are things we're looking at. Another thing we're looking at, and that we actually did prior to the April 2nd announcements, but already within that kind of turmoil period of tariff announcements and commercial fighting, is Swiss real estate. This is something that we believe is a resilient asset class that benefits from a lot of very strong dynamics, not enough supply, too much demand. It's a quality asset, and it's not so much affected by the tariffs dynamic because it's very local in nature. So that's something we've done for our Swiss franc portfolios, but also for some of our foreign denominated portfolios, because if you hedge that Swiss franc back into the dollars or the euros, you actually get a very nice pickup, and you get a very nice income stream and yield that's very comparable to some of the riskier parts of credit in those areas without the default risk that you might experience if you have spread widening. So
very interesting. Ivan, coming to you on the advisory side, what kind of conversations have you been having with clients over the last few days, and really how's your positioning evolved in response to what's happening?
It's really great, to talk about a chief economist and a chief investment officer, because already all was already said, but it shows as well that the extraordinary consensus we have in the markets now. So I think we all receive a lot of monthly letters or special letters, etc., from fund managers and asset managers, and I think the consensus is quite extraordinary. The same, exactly what the elements that Adrien and Michael just gave us before. On our side, what we do, and especially this morning, we had a call with all our bankers in Switzerland. Our CIO made 15-minute calls talking about our view. We didn't change anything, to be honest, but we were quite defensive for some time, so we didn't change. But what we try to convey is really this message that's back to basics. Keep invested. Diversification. Michael, you just told it. Diversification. Try to this is not now. This rebound. We have to be very careful and not miss it, but as well not being caught in a falling knife pattern. But that's what we try to tell to our bankers, and then it's the role of bankers to convey this message to the clients. Not easy, because that's something we felt from our bankers, that they're not as informed as we are in markets. They've not access to a lot of resources, to a lot of people, to a lot of calls like this, like this one, for example. So that's really our role now, to reassure, to to give them this, to help them navigate through this volatile. I wouldn't say difficult, but volatile times. That's in a nutshell.
As you say, it might be a bit too soon to try and catch the falling knife in US equities, at least at the maybe market cap level. What kind of safe havens and diversifiers have you been looking at? Obviously, we've heard so far a mixture of things from structured products to gold to Swiss real estate, to sort of reasons outside of. So no, sorry for that. We've taken a few options there, but feel free to double up, obviously.
No, exactly. It's exactly like Michael said. We, in terms of asset allocation, we can, for Raiffeisen in alternative investments, adjust Swiss real estate and gold, and we are overweight Swiss real estate and gold for years. We've been in, so we will stay like this. Then for gold, and we will reassess our positioning. I think in the future we'll see the situation evolves in the coming months, but we are quite defensive, as I said. We are slightly overweight Swiss equities and underweight Europe and emerging markets equities, but we decided to cut our underweight US equities. I think it was in December last year, to become neutral. Was it a good move? Still, I think we think it's still a good move, but it's just keep invested. That's really what this message as you want to convey. I think our concern, or yes, a little concern, it's not a fear, it's just a concern, is the role of the Fed in the coming month. They will have, to choose between, en français, peste and choléra. So because, to boost growth or to fight inflation. And I wouldn't be a central banker, I promise you.